welcome everybody to Hampshire Capital. This is our investment webinar for Trammel Creek. It's a land development investment opportunity. A little housekeeping rules. We'll have questions and everything. Please put them in the comments as I go through this. I'm sure there's going to be questions that hit your mind. Please feel free to get those in the comments. Also, Brendan, our RI guy is here. He will put the investor portal in the chat as well, and he's here to answer any questions as we go through this. As we go through this webinar, you'll see all of our track record, the things that we do special here at Hampshire Capital, and we'll have a time for Q&A at the end, so please stick around as we get towards the end here. I want you guys to be able to take value with you. That's our promise to you, is you have value by taking these answers that you take from us with you. So thank you all for coming in today. Talk a little bit about our team. I'm your MC today, Eddie Austin, Vice President of Operations and Construction. Shane, please take us away, buddy.
Hey, thanks, Eddie. Appreciate everybody being here today. I'm Shane Carter, CEO at Hampshire Capital. My role here is really in structuring a large picture vision and path for the company, capital market structures, as well as partnership and deal structures for the organization in terms of how we're buying opportunities and how we're structuring those. And then, of course, helping to run the culture of our organization, which is really how we conduct ourselves, and being hopefully a good guidepost for everyone in the company accordingly.
Thanks, Shane. Nick, go ahead, buddy.
Thank you, Eddie. Good afternoon, everyone. Thank you for joining us. My name is Nick Bouquet, Shane's partner in Hampshire Capital, principal of the company. Been involved with commercial real estate for about 15 years, transacted on over 7,000 multifamily units. And my role here is primarily two functions. First is assisting and overseeing all aspects of investment sourcing, underwriting, and analysis for the acquisition side of the business. And then I also run the day-to-day operations and the COO function for all the aspects of the company.
Thanks, Nick. A little bit more about me. Been in real estate since 2004. Managed large portfolio of construction, commercial investments, and construction projects nationwide, from housing subdivisions, multifamily, industrial, and commercial. For me, I really pay attention to the construction aspect of this. As we all know, when we do value-add stuff, construction can make the ship go any way you steer it, and I'm here to make sure that it's going in the right direction. Brennan, take it away, buddy.
Thanks, Eddie. Good afternoon, everyone. My name is Brendan. I'm in charge of all things investor relations here at Hampshire, and the newest addition to the team. My goal here is just helping out, answering all investor questions that you guys might have about this fund opportunity or any direct investment opportunities we have, and making things clear and, hopefully navigating Hampshire Capital into the right direction as we start to begin, really scaling and growing more than we have in this past. And we're really looking forward to, developing relationships with each one of you. So I'll be your first point of contact for anything that you guys have related to that.
Thanks, Brendan. Luis, take it away, bud.
All right. Thanks, Eddie, and every guest on the call. My name is Mo LaPointe, a VP of Land Acquisitions. I've been involved in multiple commercial real estate transactions over the last several years. Valuation is close to $100 million. Currently focused on delivering value creation of residential projects, through our land development platform positions, and certainly excited to have everyone on the call to learn more about our project.
Thank you. Michael, take it away, buddy.
Yeah, thanks, Eddie, and thank you guys for being on the call with us. My role at Hampshire Capital is VP of Asset Management. So my first and forethought is that everything that I'm doing is trying to make sure that targets that we set for these projects, these funds, everything that we're doing, they're being hit, or they're being exceeded. So, from my standpoint, I'm in operations, budgeting, renovations, investment on a daily basis with what we have going on our properties. Overseen a portfolio of over 7,000 units and $1 billion since 2007. I'm a private investor as well on land deals as well as multifamily. So, my skin is in the game. I'm in the game, and I enjoy seeing this on a daily basis of what we do. So I'm excited that you're here to listen to what we have going, and thanks for joining us.
Thanks, Michael. All right. What makes Hampshire Capital unique? I love talking about these things, and And Michael and I just actually got back from a property, a tour on an asset we own. We walked doing the due diligence on the deferred maintenance and the construction. And what I mean by that, due diligence to that, we already did the due diligence, right? Well, that's what makes us unique is we have this investor first philosophy, and we have a complete alignment and transparency around capital preservation. Those efforts are preserved by physically going to these assets and making sure that we are adhered to our business plan. So, that's how we reduce the risk. That's how we promote cash flow. That's how we get tax mitigation, is making sure that when we did the right things on cost segregation, we're hitting the right KPIs on the back end, because we are investors as well. And by doing that, looking at deferred maintenance, looking at construction, making sure we're hitting the business plan, we are guiding that live as we run through the deal as it matures. Another thing is, while we were there, we have a neighborhood first mission. We have this mission wrote in our website. We have these missions wrote here in this pitch deck. But are we achieving that? Does the neighborhood look good? How is our curb appeal? Are we trimming the grass? Does the landscaping look good? We're giving that a score. And that is why we put neighborhood first mission, because we prioritize the positive impact of the residents that we serve as a cornerstone for long-term growth. We're improving the neighborhood. We're a team of experts. I say professionals. We're dedicated to full cycle commercial real estate and alternative investments. Not only just real estate investments, we do alternate investments as well. So we understand everything. We're very well rounded and educated in the service department of investor relations. Talk a little bit about our track record here. The principals and partners here at Hampshire Capital, we have collectively over 70 years of experience in renovating and owning, operating apartment buildings and commercial properties, including land development. Transacted about 5,600 units and $550 million in value, and 320 units transacted in land development and $125 million in value. Common investing fears. Man, I go to conferences, I get in these rooms, I go to these meetups, and even go, I'm on Facebook every day, and people send me a text or an email or even a Facebook message and say, Eddie, are you sure you're wanting to invest today in 2024? So here's the common questions that I get hit with all the time. I know Shane, Michael, all of us, we always get these questions as we're out and about and we're in the general public eye. So, is now 2024 the best time to be investing in real estate? I'll be completely honest. I've never seen a bad time to invest in real estate that causes good or creates a good return. It takes a team of people, team of professionals to operate that through turbulent waters and headwinds that we have like today. But as long as that can be done, you can still maintain good returns on a property. It's never a bad time to buy real estate. So I would say question number one, hey, it is always a good time as long as the numbers count, they work, it's got a good business plan, and you got a good team of professionals behind that investment to make sure that it will go like the business plan and we will move through it in a good manner and give good returns. So absolutely, invest today, right now. Why should I invest in a fund versus individual properties? This is probably my favorite question. I get asked this all the time because I've put for a long time on any of my social media accounts, I'm a fund manager. What is a fund manager? Man, a fund manager, we manage a portfolio of investments to where you're not singly invested in one asset. My favorite analogy for this is syndications. I'll pick on them for a minute. So say we're going to go buy 5,000 units together, and we're going to do that 350, 400 units at a time. That means we got to do 13 syndications. Do we believe that we're going to do 13 syndications correctly? You're going to try. You're always going to have skeletons in the closet. There's going to be things buried, be things that's unknown. Just like for us, we bought properties and the property taxes went up. Insurance went up, like that for everybody in the last couple of years. When that goes up, it brings down the returns. It drags it down. If you're invested in a single asset, it's not good. If you are invested in a fund where we did this exact same 5,000 units together, and we did this in, say, 5 or 6 funds, and we have 3 to 4, maybe 5 properties apiece, if one property gets hit, it doesn't mean it drags down the returns for everything. it drags it down altogether, not just one single asset. So it can be the difference between getting a cash on cash return and a no cash on cash return. Last one, what question should I ask my fund manager before investing? I know Brendan's going to go a little deeper on this later in our slide, but we believe you should ask the right questions, like underwriting questions. How have you mitigated the risk? How much money are you personally investing in this fund? And you certainly will see that we are investing in this fund and any of our opportunities. So make sure you ask good questions. Look, it's your time to educate yourself. You're getting paid to educate if you invest with somebody. They should be able to educate you on the risk of the investment, and they should be able to answer your questions with confidence. Here's our executive summary here. First, we're going to go down here on the right-hand side. It's a $50 million target raise. It's the size of the fund. It's a 10% preferred return. Anticipated returns are a 20 to 28% average annualized return, and it is a 5 to 7 year hold, and there is no fund level fees. So inside of this fund, there is no fund level fees. Oftentimes when you see funds, it's usually a 2 and 20 model, and then that's the most common that you see on the front end. Well, there's also fees that's kind of hidden inside there unless you really dig into the fine print. Sometimes those fees can be up to 5 to 7%. You're really dragging down the returns to the investor. So that's why we say that the alignment is our alignment of interest is aligned with the investors. We care about you. We want to see you get your money back. We don't want to fee it to death. Over here on the left, we got multifamily. There's 3 different types of real estate that we put in our fund here. Multifamily, it's stable. Its apartment communities provide a stable, balanced return from cash on cash or cash flow and appreciation. They appreciate very well with the NOI. The outdoor hospitality is a cash flow. It's an emerging asset class, and it generates higher predictable monthly cash yield. And land development, although it doesn't pay a cash on cash on a month over month basis, it has a very high total return. It is a detailed risk mitigation process with a high total return. Our investment structure here. This is our thesis when it comes to how our fund operates based on invested capital. Your investment size changes these metrics. We'll look up here on the top right corner. You'll see a Class A, and it's a 5-year projection. It's a 17% IRR and a 20% average annualized return and a 2x multiple. So how that happens is it's a 70-30 promote on the general partnership and LP split. You still have your 10% preferred return, but that's for someone that invests $100,000 to $499,000. You can see the other classes here, again, how they're tiered and how that changes the promote split. The preferred return stays the same, but mostly it changes your IRR, your ARR, and your EMX. And again, no fund level fees. It enhances the return for a larger investment. The benefits of investing in a fund, number 1 is diversification and risk mitigation. First thing we're going to do is we'll go over here on the left-hand side. You'll see multifamily. It's a big piece of this pie. 65% of this fund is set aside for the multifamily asset class to balance cash flow and appreciation in the fund, also give good tax benefits. Your outdoor hospitality, again, is a high cash yield, and land development is a high total return. So how do we derive at that? It's a smart balance of stabilized cash flow and high returns and exposure to a mix of strong geographic markets, meaning this fund doesn't invest in one single city or state and invests in multiple cities and multiple states. It gives you that diversity. Access to unique asset classes. We've got 3 different types of classes here. Beneficial tax efficiency by mixing all 3 of these together, and then efficient use of investors' time. What do we mean by that? We look at, you could certainly go out and invest, $50,000 a piece in all these different types of single syndications, but that's taking more time for you to physically fill out more paperwork. You can invest in this fund and you have a blended return with all these assets in the one investment. Hopefully we're writing these questions down, folks. We got Q&A coming up. Shane Carter, go ahead, buddy. Let's hear about the Hampshire Capital Investment Framework.
All right. Thanks, Eddie. Appreciate it. So, we have a very disciplined approach to how we approach our investments. First, we start with the macroeconomics. We look to understand the trends that are driving housing, which is really where we predominantly focus our investments and where our track record and experience is. And so we look at the macroeconomics, where are people moving, what are the demographics like, where is housing in demand, and then we drill down to the neighborhood level and really understand from a very detailed data-driven analysis what is happening at that neighborhood level, because every growth market in the South is not a great growth market. They vary by neighborhood. So we really drill into the neighborhood level to understand what's happening at that micro location to ensure that we have the right tailwinds for our investment. So strong partnerships really is about just working with best-in-class operators and capital partners. Both when we structure partnerships, which is a lot of what I work on, we're really looking for, first of all, quality folks, quality individuals, make sure that we have morals and ethics aligned. And then, of course, that they have a detailed system for management and reporting. And we really focus on ensuring that they have best-in-class operations in hand. So risk mitigation, we prioritize preservation of capital. Look, we're investors in this right along with all of our investors. And so, we work hard for our money, as do you. Preservation of capital is job number one. We have to make sure that no one ever loses a dollar and that we're safely and intelligently growing that capital. Again, diversification, Eddie already touched on that. Cash flow yield, total return are the parameters for the balanced fund. And we think that we have a great combination of those factors in this fund, and that's why we structured it the way that we did. Active management, that's really like Eddie discussed earlier with what Eddie and Michael were doing today. We are very hands-on. We are absolutely in the weeds on every single deal. We are managing the day-to-day operations. That is a prerequisite for our funds investments, is that Hampshire Capital be actively involved in the management of every investment. And that's how we know that we can drive the results and the yield that we need in our fund. Because this is a hands-on business. This is a people business. And this is an execution business. No matter which one of the three legs that you're in our investment asset class, you still have to be very, very active in this business. And then again, Eddie touched on this a little earlier, people first philosophy. We really put our residents first. The folks who are buying our communities and in our communities, we put them at the forefront of our decisions, and we put our investors at the forefront of our minds. Again, our capital's alongside with you. However, we really try to take the mindset of if this was my grandmother investing, how would I treat her? And that really carries through in everything that we do.
Absolutely.
My grandmother living at this property, how would I want it to look and feel?
Absolutely. I'm going to hone in on one more thing real quick. And I think I want to do this because of the conversations that we had today. So, Michael, I want to talk about real quick, the active management, the amount of hands-on. Like today, you've been doing a very in-depth investigation on leads and lead to lease. So, Michael, would you care to explain how active you are? Everybody knows that we have third-party property management, right? Everybody understands that. But here's what a lot of investors, especially new investors, don't understand is how much goes on with asset management to actively drive, innovate, and get these characters to perform. They may be good at keeping the asset clean, keeping the curb appeal up, keeping the grass mowed, keeping the residents happy, but we have to be the ones that really drive the appreciation, the value of the asset through the net operating income growth. And Michael, if you would please touch on that, what are the things that you or key metrics that you're constantly looking at and constantly asking the team about to pay attention to?
Yeah, Eddie, thanks. From my standpoint, from what we do from an active management style is a third-party manager. They're great, like Eddie said, keeping kind of the ball rolling on a normal basis. What we have to do is be innovative for them in many cases with the ideas of what are things that are outside of the box that they're not doing. What are we looking at from a standpoint of an example being our leads? We're not getting enough tours on the property or people coming to visit. There's the question of why. Well, the first answer that many third-party groups will give you is, oh, it's the time of year. Well, I'm not one that accepts that as an answer. And the reason why is because I want to sit there and know for sure that that's the reason why. So I'm asking for things like, I want to know exactly what's going on, and I'm calling our competition around. I want to find out exactly how many tours are they doing? How many applications are they getting? I get good information. I get mixed information. So I compile it all. And, a lot of my background for me as I used to be an actuary. So you guys know that I'm a detail guy right there. I love the detail. I love understanding how are we going to make our money by being more efficient and different than what our competitors are doing that are just hiring somebody and saying, go out there and get it done, and I'll call you in a month. So on a daily basis, I'm looking at fundamentals. I've created a list of tea leaves that I go through on a normal basis to sit there and tell me, is the property running efficiently? I've got a red metric, a yellow metric, and a green metric to help me determine for each of these tea leaves whether or not they're running at the right place, and if there's things that are sticking out that tell me that we need to be asking questions on that. So it really, sum it up wise, you're constantly looking for anything that's changing. You're constantly out there trying to figure out, how do I need to go about getting the maximum out of my team, getting things done for my team, so then that way they're able to perform at their peak. Did I give them everything they need? And then lastly, it's just making sure that you're putting the onus on these individuals that you're hiring and that you're trusting to be your partners to say, hey, are they following through on their portion of it? Because as an investor and representing other investors, I have to make sure that we're not leaving any stones unturned, and that that we're allowing us to have the maximum opportunity to succeed.
Thank you, Michael. Nick, I don't think anybody underwrites more properties than you do. At least I would stand up for the argument of that. So would you please take it away on our market observation currently in 2024, going into 2025?
Yeah, thank you, Eddie. Yeah, I'd say that's certainly true here.
Yeah.
Can't speak to the larger ecosystem, but
yeah.
So as Eddie's been describing, the fund it's made up of three components: multifamily, land development, and RV outdoor hospitality. How we're thinking about deploying capital into these three buckets is largely a function of where we're seeing the opportunities in each given sector. I'm going to start with multifamily because it's the largest portion of the fund, and the piece of the three-legged stool that's, I would say, has had the most near-term trouble and challenges. We love multifamily. We absolutely believe in the long-term fundamentals story and the investment opportunities there. But we have, the data is showing us that we're still in a bit of a falling to starting to stabilize scenario, and we're really looking for the data to begin to tell the story that market rents are stabilizing, concessions are stable or reducing, and that occupancies are improving or stabilizing. And year to date, that has frankly just not been the story in the Sunbelt markets that we're tracking. So we've had a very challenging time finding investments in multifamily that make a lot of sense at the moment. The data, I just pulled the recent data, and for Dallas, for example, and we're still seeing that same trend. We're optimistic that's going to begin to stabilize and improve starting this quarter, and certainly into 25. But we expect the multifamily component of the fund's capital deployment to be largely focused in 25. However, in the near term, we are seeing sort of strong opportunities in land development and outdoor hospitality. These investment classes, certainly land development, which is where we're primarily focused at the moment, we expect to deploy capital in 24 and certainly into 25. And the fundamentals and the demand remain strong here in both these aspects of the fund in the near term and for the foreseeable future. So, any questions, Eddie?
Nope, I think that's great, man. We'll hit on the land development stuff a little bit later on the actual asset here. Thank you. So Shane, nobody knows land better than you do, man. It's where you come from. You cut your teeth in it. Let's hear.
Yeah, thanks, Eddie. So yeah, I've been doing land development for over 20 years now. Absolutely love it. And that's why we brought it into the fund is due to, our track record and experience and deep knowledge and understanding of it. And of course, why I continue to allocate my capital here is not only because I know and understand it and understand how to mitigate the risk, but also it gives great returns. We've averaged, close to 50% annualized returns in our land development projects over that time period, which is just absolutely unheard of. However, a lot of folks would say, okay, well, you got high returns because you have high risk, which was certainly true in the early part of my career. But now we've really gotten this business down to a point where the risk mitigation is of primary importance because I'm not interested in losing any of my capital. And we'll talk about how we mitigate that risk further, at the end of the slide and the next. But the other reason it's in the fund is that it's just got high barriers to entry. You either have to be, a guy like me who kind of grew up in construction and development to understand how to get into this business and understand how it works. And it's usually reserved, for folks who have money and already understand development. And so we wanted to bring this asset class into the fund to allow enhanced yields in a balanced way into our fund. And it's got, again, just great total returns in a relatively short time period. You're usually in the 18 to 24 months is sort of a typical process. And they can be as low as 9 to 12 months for an entitlement and sale process. So they're very amazing returns that usually most people just simply don't have access to. So let's talk about the fundamentals next. We have a national housing shortage. Everybody knows that. The tip of the spear for housing is land development. If you don't have land entitled and approved, then you're not going to have any housing. So we focus in the part of the ecosystem that is really extremely important. And how we take this business model on is really in service to the national home builders, where they're building at scale and they're building the vast majority of all housing that gets built in this country is built by, frankly, the top 10 largest nationally traded home building companies. And they have a fundamental need to have off-balance sheet development partners, and they need deal flow and they need land, and that's where we fill a critical role in the ecosystem. And so we'll talk more about that, which is how we also mitigate risk. So the risk mitigation part really comes through our detailed understanding of the process and how to take risk off the table. I'll start with the fact that on the entitlement phase, we don't take an investor money. We use all of our own money to ensure that we have a zoning risk completed and that we have a density analysis completed so that we know fundamentally what we're going to have there. And then it's just a matter of ushering it through the process. But we are not going to put anybody's money at risk except our own until we have all of those details mapped out and we have absolute assurance that we're going to get the zoning and the density that we need to complete a project.
Absolutely. Thanks, Shane. All right. The investment introduction. Thank you guys for staying this long. We're going to get into the weeds here a little bit. So this particular investment is in Crestview, Florida. It's 258 residential lots. It's comprised of 188 townhomes and 70 single-family homes. This acquisition was sourced off-market. We have forward purchase contracts by a national home builder. We have an underserved growth market in Crestview, Florida. It's well positioned. And then we have reduced counterparty risk by, again, the forward contracts, purchase structure, and significantly reducing the risk. And it's not speculative. All this is entitled. We have paper on every phase of this. Everything's been done, density studies. It's all finished out. Just as Shane said, we've taken out all the risk. We put our money up first. It's a phased acquisition. The buyer will take down the lots in strategies, like 50 lots at a time, until the project is 100% complete. And then site readiness. It's fully entitled. It's shovel ready upon acquisition. Next, our investment summary. The land purchase is $3.2 million. We're raising just over $2 million. It's right at 2.1. And the total project cost is a little over 13 million, and the project timeline is 2 years, and is a 30% average annualized return, which speaks to a 1.6 equity multiple. And you'll see we've got Tractor Supply, McDonald's, Waffle House, and certainly more exciting major brand name stores and restaurants that's close to this property. Again, it's 34 acres, and there's plenty of room here for expansion. And we've got it slated out very nice to put these homes in, and it's not over dense. Mo, if you'd like to talk about our the drivers of the housing demand that we have here, I know you have some inside information from all the work that you've done on the due diligence phase.
Hey, Eddie,
Yeah.
before you move on, can I ask a question now?
Yes, absolutely.
Could you go back to the previous slide?
Yes, sir.
So the way I understand the land development, this is really, you're out as of the completion of the land development, or do you stay on board and just hold those remaining lots in inventory? Number one, and number two, I would assume time is money. Therefore, the longer you hold the lots, over time, the price of those lots does slightly escalate over the course of the job. And is the total risk, I know this is a multi-part question,
Sure.
is the total risk is not 13.1. That's the total cost of the project. So
Correct. So
Yeah. Ed,
go ahead,
you mind if I field this?
absolutely.
Yeah, appreciate the questions. Those are great questions. So, I think if I remember them all correctly, the phased build out is when we put in the roads. So our structure here is we're going to go in, clear the lot, grade it, and put in the roads and infrastructure, and then sell the finished pad sites to a national home builder. And so in that process, that is when we are taken out, is when those lots are purchased. Eddie went back to this slide because we have the phased acquisition as well. So they take down the lots in stages. They're not requiring us to build the project to 100% complete before they start that. So we get the roads and infrastructure built and connected and tied in, and we get it through the first 50 lots, and they meet the specifications. They buy them right then and there. Then we incur additional cost and expense to proceed into lots, 51 to 100, and then they close on them there. And they're closing on them every 3 months is the pace in which they're taking down 50 lots at a time. So we are phasing our expense and our costs in line with getting the finished lots purchased. So that also reduces our risk. And as far as the lot price increasing, no, it doesn't. We sign a contract with them. They get fixed pricing on the lots for the entire development. And our max loan exposure on this, even though it is a $13.1 million total cost, our max loan exposure is about $6.5 million. And then, of course, every tranche that gets sold, that max exposure goes down and down and down, so that we're constantly diminishing risk throughout the length of the project as well.
okay, that makes sense. The next question is there a sunset in the agreement? In other words, if this thing goes beyond 2 years, it seems to me like all of a sudden now your expense now goes up, time value money, right?
Yeah, that's right. Yeah, we have interest carry with the lender, and obviously we're paying a 30% pref to investors, on this deal. So yes, time is money, and time value of money is absolutely at play here. And so if the builder doesn't take down the lots at the cadence and the tranches that they agreed to, it becomes pretty punitive to them in terms of what that penalty is. And we get deposits from them as well. So we get hard money deposits from them that they have to basically walk away from if they don't perform. And they're generally at around 10% of the finished value price of the lots. We have some other ones in our pipeline now that we're negotiating closer to 15 to 20% of the finished value of the lot. So they have a lot of skin in the game and a lot at risk if they slow the pace or try to back out in any way.
Is that why, Shane, and again, my last question, Is that why, these things have inherently much more ROI because of that inherent risk in the development costs and the carrying costs while you're carrying the builder inventory? And granted, part of that time period is while you're, constructing it, and I can appreciate that. So if that is the case, does that drive the ROI not, excuse me, does that drive the ROI down, and or does that improve the return on the fund? Because it seems to me like a 60% return is a hell of a lot better than a 23% ARR in a syndication. Does it have any effect on the fund, or is this just the way that you guys are sort of diversifying and protecting against downside risk on the multifamily side?
Yeah, well, I mean, certainly it's a diversification play, of course, but relative to your ROI question, David, no, the ROI doesn't change. It's a fixed pref return that's being paid to the investors in this development deal, which in this case is the fund. So no, if it goes 27 months or 28 months or 30 months, or it goes over the pre-allotted timeline, that 30% pref is still what's going to be paid. So where the ROI gets changed in that case is to the developer. And the development entity gets less yield and less return accordingly, but the investors get the same exact yield that were promised.
Yeah, gotcha. Meaning you don't have to go out to a banker and access this capital as long as you're in control of the capital via the fund.
Correct.
Awesome. Thanks for that. Sorry for being so detailed in that, because I've been through a few of these.
Yeah, no,
Just for full disclosure here to anybody else listening, we are already partnering with you guys on a syndication deal. So I just didn't understand how these deals work, and that's why I'm here today.
Yeah, no problem, David.
hey, David, I was glad to let you ask that because I figured you had something really good on your mind, and it was actually relative to that slide. So I wanted you to get that question out. And thank you for, all the amazing testimonies that you've gave us in the past. This is certainly questions that people should ask. Oftentimes we've done these webinars and people, in our opinion, are not asking enough questions because look, this is your opportunity to educate yourself, to remove the limited beliefs during this time in this call. We've got all these people here, all the executives on the call. Let's ask, let's figure it out. That's why I asked, put your comments in the chat. And certainly we want to do this for you because we know that this is not something that you see many times. You've seen hundreds of thousands of syndications that come past your Facebook advertising and social media advertising all the time. You like and understand the multifamily aspect. Maybe you do, maybe you don't. But at the same time, we know this is different. That's why we want to do this, so we can educate you through it. So thank you for those questions. Mo, if you please take it away on the drivers of the housing demand here. I know you've spent a tremendous amount of time understanding this market and why we wanted to go forward on this project.
Yeah, no, certainly. Thanks again, Eddie, and again, everyone else that's on the call. I mean, certainly Crestview is, unique relative to the rest of the Panhandle area. I mean, when we look at Crestview, and obviously on the slide, kind of speaks to some of the drivers in terms of job creation, whether it be from the Elgin Air Force Base or really the Shoals River gigasite that's coming to market and the job creation that comes to that. One of the things we think about is really when we say attainable housing, right? What does that look like market specifically? We think about really the pressures on sort of the coastal areas of that panhandle and really where Crestview sort of sits in relative to that, right? We also think about, how we can really deliver locally based residential solutions through value creation and collaboration. Shane kind of alluded to risk mitigation. One of the ways that we like to mitigate risk is really how is that local municipality working alongside potential development opportunities? And we found the city of Crestview to be really a partner in that respect. And certainly, I think, from an investment standpoint, we really want to understand risk mitigation. But look, the drivers of housing demand is really where it's at, right? What are we supplying? We do see, what I believe is downward housing pressures for affordable housing, right? Sort of in that non-coastal area. And this is where we can really deliver that true opportunity for folks to participate in attainable housing. And again, we want to make sure that, when we're looking at the opportunity, where are the opportunities to mitigate the risk, right? So one of the things that we look at, and we joked about Nick and how many deals he underwrite. We're very conservative in our pro forma. And when we looked at data, and specifically relative to the rental market and the market overall, we also looked at, sort of housing needs and working with the local housing authority, what's that wait list and kind of what's that demand driver route. There's more than 300 families that's really looking at attainable housing opportunities. And when we look at our pro forma, we sit below kind of what that housing voucher would look like. So we think overall the housing demand is there for this project, and certainly it certainly makes sense kind of long term.
Thanks, Paul. So look at sources and uses here for a minute. Always a slide that, everybody should ask their fund managers. What's the sources and uses look like? Where's the money going? What is it doing? What buckets does it go in? So on the right-hand side, first, construction loan, it's 85% loan to cost, 75% loan to value, 14.5 fixed. It's not a floating rate debt. It's not a bridge loan. It's 1.5 on the origination fee, which is relatively low, and it's 24 months, and it's 24 months interest only. So now to get in here and separate out the buckets, we got the construction loan of $11 million. We've got our equity, again, around 2.1, and that brings us to about a $13 million total. And then we got our land acquisition, we got our acquisition costs, you have your soft cost, and then you have your construction cost, 7.3, and a financial cost, and then project contingency. Another thing, when you're looking at any type of construction, because I'm a construction manager, also operated a lot of these deals, is you have to have a contingency for the oopsies that get forgot, fees go up, there's certain things that happen. Sometimes there's a fee that has to be paid before something else gets started. And if those are forgot, you'll wish you had a contingency, because they will ultimately drag down the returns from the investors. So make sure you have a contingency bucket in anything you invest in. All right, before we get started with Q&A, I want to hear from Brendan on what is the number one question that Brendan gets consistently all the time, because I know you hear on a lot of calls with potential investors and current investors. So Brendan, take it away.
Yeah, thanks, Eddie. I hear a lot of questions, but David, I think earlier when we were speaking about, this preferred return, regarding that, I just want to bring up like the importance as an LP seeing that preferred return. And when you see one as high as 30% like we're offering here, you should know that the sponsors truly have to perform. Us as sponsors truly have to perform in that scenario in order to make money. As that waterfall structure, it really incentivizes us to have to perform, number one, right? So as an LP, you have that confidence behind you, knowing that we really have to step up to the plate here in order to make money. And the reason I bring that up is because that goes hand in hand with the number one question I receive all the time, which is, what's your track record? And by far that's the most common question I get, and I think it's for good reason, right? People want to know, this data is great, this deck is great, you guys seem to understand what you're doing here, but do you have any track record to prove it? And I think over the last 3 decades, Shane has proven himself through that method, and everyone else on this team as well, right? And he's been able to amass well over 50% for average returns, which is fantastic to be able to leverage in these conversations with you guys. So I would say track record is probably the number one thing, and I think the waterfall structure that we have here in place is a testament to that, because of our confidence in risk mitigation and in our performance in the past. I think we feel really confident about this deal in particular.
Does anybody else have any questions? Please feel free.
I do.
Yeah, I have a question in regards to track record, specifically for land development deals. Have you done this before, and have you done it on this scale before? That's 258 units is a lot of pretty big 34-acre tract. Have you done projects this big before?
Yes, I have. For the last 20 years, we've done I've done over 120 million in land development projects. So this one being about 13 million is well within our wheelhouse in terms of project sizes that we've done. And so the part about this that we like is we're really just going in and doing the site work. We're not going vertical. We're not building housing. We're not taking on that level of construction and development risk. We already took on the entitlement risk and we took that off the table. So now it's just going in and actually executing on the site work. We've got an amazing site work contractor. We interviewed, half a dozen or so different contractors before we decided on one. And we are super confident in this particular gentleman and his company and his track record and his ability to perform. But of course, we have options 2 and 3 sitting there ready to go if somebody, God forbid, a horrible life event happens. We've got contingency plans for our contingency plans. But really the execution risk is very low in these types of projects because it's just really putting in the roads and infrastructure, which in my experience is more of a simple part of the process as opposed to building vertical.
Absolutely.
Thank you. A follow-up question to that is, I know other EP groups that are literally running 15 to 25 multifamily deals simultaneously. Is this a singular focus or your main focus, I guess, on the construction side? You finish this up and then move on to the other one, or are you going to be juggling multiple large projects like this simultaneously? And is that a concern?
Yeah, no, that's a great question. Our multifamily projects really don't have major construction items in them. They're kind of mostly just unit turnover, some renovation work that is ongoing, but it's at a cadence and at a level, and our contractor base for the unit turns is so rote and understood that there's no real capacity loss there for us. And frankly, this vertical of land development, has its own infrastructure and staffing for it, and it's not taking, for example, Michael Payne's time, energy, and effort to manage. We have a separate management division. We sort of think about things in those separate verticals, so that it does not take away from capacity in any one vertical.
Excellent. Thank you very much.
Thank you. Great questions.
Go ahead, David.
Yeah, my question was on that last slide. 14.5% for financing. Is that cumulative?
No, that is annual.
Geez, man, can I invest in that bank?
Yeah. Well, we are in discussions with several large groups to start a private credit debt facility, actually. And it would be less than that. But look, this is a highly specialized lender profile. And so these groups that really understand the risk and performance for horizontal development, acquisition, AD&C, funding is what it's called. They're highly specialized firms. And there's not a ton of them. There's maybe 4 or 5. And frankly, that is not, believe it or not, David, that is not the most expensive term sheet that we received for debt on the project.
That's crazy. Is there a chance of actually negotiating that down as we see the rates start to drop?
We already asked that question, and the answer is no. But the flip side to that was they said, look, in 2022, our interest rate, or 2021, our interest rate was 14.5%. And then in 22, it was 14.5%. And then in 23, it was 24, right? So as interest rates were going up, they stayed the same. And so they're not willing to yield or give anything up as interest rates continue to drop.
So I guess to offset that, if you could accelerate the schedule 2 months, for example, that could be a lot of money.
Yes. Yeah. We have an interest reserve and a capitalized reserve for that. But yeah, you're right. At the end of the day, if we don't have to use our interest reserve and if we don't have to use our contingency items, then that just goes back into, the bucket of capital to pay returns. And so yeah, it's in all of our best interests for us to perform faster and without too many contingency items popping up.
Awesome. Thanks.
Anybody else? All right. So this next slide I'm going to share, we wanted to share our investor reports. We've had a lot of positive feedback when it comes to the amount of education that we put out and the amount of education for the people that are invested with us. And we're going to share one of our investor reports. Let Michael speak on this. So Michael, if you please walk through this August investor report here.
Well, and Eddie, this is a draft version, just so you know, so this isn't the final one yet. But from that standpoint, the goal when we were designing this was to try to help our investors understand, what's going on at the property for real, not just, hey, we don't have a distribution, or we do have a distribution and things are good, and it's kind of confusing. The messages that I think a lot of our competitors put out can be at times almost enigmatic, because you're sitting there going, well, what does this mean? How can you be having a wonderful performing property and yet at the same time not sending me a distribution? So the goal is to kind of say, what is happening overall from an operations standpoint on the property? What are we seeing that's happening? The financials may look fantastic, but my crystal ball for 2 months from now is already looking like we could have a hard time. So it's trying to take some of that information that we have behind the scenes that won't just show up on a financial and kind of say, here are some things that are going to come up as either challenges or positives for the property in the future. What's happening with our NOI? What's happening with our occupancy? And what do we see happening over the next 2 months based upon trends we're seeing and information we're getting, on our, leases or different things like that, or notice to vacates that are coming in. When we talk about positives, I always look at it for, expenses and what's going on with our staff and how consistent have they been. All of those things come in to pop up and tell us what's going on at the property. From a challenge standpoint, at this particular property, we've been having a problem with delinquencies and skips. And so, we want to make sure that our investors understand that. Why did we get this problem? What happens to drive it? We're going out and Nick's looking at different parts of data. I'm calling on Nick because he's looking at buying properties, and I'm saying, hey, what's happening over here in this area that you're seeing when you're talking with brokers? And then Nick does the same thing with me. I'm saying, hey, we're seeing some delinquencies and skips pop up. You might want to make sure if we're looking at properties in this area that that's not something that's showing up on the financials. So, the investor report to me is basically what I look at as what we're talking about with each other inside of Hampshire Capital. How are we sharing information with you? It should be the way that we're looking for the properties in the future. And also, we know that we have, some investors that maybe they don't know as much about what goes on a daily basis of what's happening. And you can see we've kind of added like an education section. So they're understanding what we're going through on a property tax basis and how it's been difficult the last few years because they keep coming in with hitting us really hard with large increases year over year. And it's caused the percentages of how much we're spending towards expenses to go up exponentially as well. And so how are we offsetting that? What are we doing and working with Nick on future acquisitions to offset that and say, hey, let's take that into account as we buy, as part of the conservative nature of saying, we're not going to sit there and set ourselves up or our investors up for failure. That's the goal with this monthly report. The other part of it is, I don't know about you guys, but I've gotten quite a few investor reports from different places over time, and they get too long sometimes. The goal of this is trying to concise it down as well to where you get what you need, and you're not sitting there reading a dissertation of things that really don't tell you a lot.
Absolutely. Michael, I want to talk about the delinquency and skips real quick. And you do a great job of managing, the back door. And I want you to explain, what is the back door? So, you evaluate work orders, work orders as a risk, to be able to understand what your risk is with people moving out and people skipping because of work orders. So talk about that for a minute.
So weekly, I have meetings at minimum weekly with each group of staff at each apartment community, for example, that we have. And I'm going through what I've developed as kind of a set of tea leaves to tell me what's the health of our property. And so some of those tea leaves are things like, how many work orders do we have outstanding? How many are more than 3 days old? Which ones are over 3 days old? Are they a handle fell off? Are they an HVAC problem? How are we making sure that we're keeping up with exactly what's going on? If there's 30 work orders outstanding, for example, and I've got 10 units that need to be turned, is my maintenance staff overworked and not going to accomplish what they need to of getting units turned and at the same time providing customer service? So I need to bring in somebody from a third party standpoint to help cover if we've had a number of move outs because maybe it's the end of the month or some normal standard process that just happens where you might convert 50% of your renewals and then you have another group that's now moving out and you're moving somebody in. So it's going through that whole process of looking at your numbers, looking at what's happening across your property, and really saying, how are we handling these delinquents and skips and what caused us to get them, and how are we addressing to prevent that from happening in the future? Is there something that occurred on our screening system that we could be tweaking and making sure that we're not allowing maybe a demographic or a different, something that's going on into the property to begin with that's creating this problem for us?
Absolutely. Thank you, Michael. Well, I want to say thank you to everybody that stayed. And then I want to, we understand that land investing is definitely not for everybody. And we understand that. And that's certainly why we put together a fund. So definitely not trying to take the investment away from you, but we understand that this is not for everybody. But we want to know what you feel about it. And we want to know that you have confidence with investing in land and investing in the fund. So if there's anyone that has any last questions that you've thought of, please bring them up now. And I think the next question I would ask you is what would it take? What do we need to do better? What do we need to do different that would allow you to physically make the investment during this call? Like scanning that QR code and physically committing your funds before you leave. What would we need to do as a company to be better to make that happen?
I can speak here, Eddie. There's nothing you really, from my perspective, that you can do. I don't take any of these investments lightly. This is my first introduction to land development. So literally I'm starting from zero.
Yeah.
Certainly trust you guys. I do want to say to Michael, great job with those reports, because I do get that very report he showed. And I have other investments in other multifamily properties. I've got one that's 3 years old, and I've gotten maybe a total of 3 reports from this. So vast difference. But this is just something to consider to add to the portfolio. My question is really whether or not it is better to try to, well, we can talk offline about all of this, but I would say I see this as a benefit to the fund based on the return.
Yes. Well, that's essentially, so I'm going to go through a couple of different things here. Number one, if you look at when somebody comes to me and says, Eddie, you want to invest in something that's got a 60% return, I'm like, it sounds too good to be true. It probably is. And, with relative to multifamily, when you really underwrite multifamily correctly and actually get in the weeds, especially on a Class C value add deal and even certain Class Bs in certain neighborhoods, the cash on cash is not there. The total return is not there. And I think that what we've seen previously is privy to all these investment advertisements that you've seen for syndications. They were upwards of 25, 27% IRR, 3x multiples. They're not hitting that. So when we look at the numbers of our fund, that's how we're able to take this. Although it seems unbelievable, it's not. We definitely have a track record of returns that Shane has done, and even what I've done myself, is these investments, they fit in very well and they speak to the numbers and boast up the total return overall, and it blends it all together. And then the other thing is, just like RV parks, they provide cash on cash. It might only be 3.2, maybe 3.5, maybe if it's $2 million of invested capital that receives a 12% cash on cash return. But that's only $3 million. And then when it comes to tax mitigation, when you do a cost seg on a 400 unit apartment building, you get some really good kickbacks. And then the total appreciation, when you would do a $200 a month rent bump on a 400 unit property, you have massive NOI growth. And then if you pair that with land, multifamily, and you pair them all together, it's a beautiful scenario in our opinion.
Yeah, definitely for me, 40% of the driver in real estate is the tax mitigation portion.
Sure.
Because I've got money working in other areas that doesn't benefit from that.
Yep.
So this would be sort of the option that I use to offset some of that other income.
Absolutely. Everyone, thank you very much for joining us today. If you have any feedback, please, Brendan, if you can share your email address or anything, invest here at Hampshire Capital, email that. Get a hold of us any way possible. Reach out to us on social media. Get a hold of us, and we are happy to answer any questions. And thank you so much for staying till the end. Have a great day, everybody.
Thanks,
Thanks,
guys.
everybody.
Thank you. Take care.